the things that is so important for us to learn is that we got to learn the new rules of money, right? Because money have changed drastically. The things about money is changing, how we go about money is changing, and how we think about money is changing drastically. And we really got to know how to approach money in this manner. So let's talk about some of the things that's going on, right? Now, when you think about financial independence, it's a decision, right? It's not a dream, it's a decision. And as long as you make a decision that you want to become financially independent, nothing could stop you. Once you make a decision, nothing can stop you. So the first thing we got to look at the fact that I just want you to imagine a few things, right? Imagine what your quality of life could be like if money was never an issue. Imagine what it would be like to control your life. Imagine if you could have it all. Imagine if money was not a concern. How awesome would that be if money was not a concern? But most importantly, imagine the life your children could have. But also, I want you to imagine the trips you would go on. Imagine the life you would live. I also want you to imagine. You know why I'm encouraging you to imagine? Is because today we live in a society where people stop dreaming. People stop dreaming because society have told us that we need to stop being dreamers. We got to keep dreaming, guys. You can't give up on your dream. But let's talk about some problems. You see, money is a problem for everyone in America today, right? And some of the problems that we're facing right now is the fact that debt, right? You know, Rashida, when it comes to debt, it says that the average total debt is $35,768. That's included in mortgages. And did you know that when it comes to taxes, Americans would have spent, in 2018, Americans spend more money on taxes than they spent on food, clothing, and housing combined. That's where taxes is today. And when you look at the fact that inflation, did you know that the average inflation rate right now, right, is 9.1%? But it says that the inflation rate from 1972 to 2018 was at 3.97. So most people say, well, why is this? It's because we print more money than we actually earn. That's what inflation is. Now, when it comes to savings, you know, they said Americans save about 5.4% of their income. And that's comparison to Germany that's saving 9.8%. And then we also have Spain that is saving about 11.78%. So what is that telling you? That we are known for what? Not saving, but more for consuming. So we got to really take the time to really learn how to become better savers and become better money managers. Now, also when it comes to life insurance, one of the things that people talk about is the fact that if you die tomorrow, your family could actually be broke in a year. And the fact that the average face amount of an individual life insurance policy that is issued in 2017 was only about $163,000. You know why that is? It's because many people today do not know what is their dime. Many people today do not know what is their dime. And the reason why they don't know their dime is because no one can teach them what is your dime. The dime stands for how much debt you have, what is your income needed for 10 years, and then also what is the balance in your mortgage and educational planning for your children that is needed. Once you calculate all that, it will tell you how much coverage that is needed. It is so important for us to learn these little fundamentals. Now, when it comes to long-term care, one of the things it said in 2019 is that the annual median cost for a home health aid was $52,620. And the annual median cost of a nursing home in a private room was over $102,000 plus. How are we going to be able to afford that? Who pays for things like this? Are you saving up to think about long-term care? Now, when it comes to retirement, they said that 10% of Americans will retire in poverty. That's where we are today. 10%. How are we going to live a life in retirement knowing that 10% of us will be in poverty? That's why we got a plan. So that's why it's time for you to learn how to take control. You got to learn how to take control of your finances. There are things that you can do now to make that difference. And that's the reason why we teach people. So here's the first thing we're going to teach you here. You're going to learn how to pay yourself first, Rashida. You will learn how to pay yourself first. You will learn how to put yourself and your family before any other obligations that you have. You got to pay yourself first. The money that you save today will save you tomorrow. You got to learn how to earn additional income and to speed up your success. Consider part-time work with us. right? And build a second source of income. That's the reason why we're always constantly expanding, and we're always constantly looking for people that want to earn additional income on a part-time basis with us. We teach you how to earn money, and we also teach you how to save it, how to grow it, and most importantly, how to protect it and build and continue to, pass it on to family. These are things that we teach in families today on how to win. So we got to take the time to learn how to win. But most importantly, here's another thing we're going to teach you. You're going to learn how to adjust your lifestyle, right? You're going to learn how to set priorities straight, what is important to you, and pretty much develop a disciplined budgeting plan. The thing about budgeting is that many people think that tracking your spending is budgeting. It's not. Budgeting is knowing how much you can spend and how much you can save before you do either one of them. But you're also going to learn how to avoid the credit trap. You're going to learn how to buy only what you need and versus what you want. You got to avoid using these credit cards because the interests are sometimes too high. So you're going to learn how to change your thinking. You got to change your thinking, guys. Because when you change your thinking, you can change your financial paradigm by changing the way you think about money. You can't just focus on making money. You got to focus on 4 things. Write this down. You got to focus on how to make money, how to save money, how to grow your money, and how to protect your money. These are the 4 fundamentals of things that you got to focus on when it comes to thinking about money. So here's the six steps to financial security that you will be learning here in our program. You will be learning how to, number 1, how to increase your cash flow. Magda, you're going to learn how you can earn additional income and manage your expenses. These are the first things you're going to learn. Also, number 2, you're going to learn how to manage your debt. You will learn how to manage your debt, Rose, because you're going to learn how to consolidate your debt and how to eliminate your debt. How many of us want to become debt-free? These are things that you're going to learn. Also, Rashida, you're going to learn how to create an emergency fund. You will learn how to create an emergency fund. You're going to learn how you can save 3 to 6 months of your income to prepare for those unexpected expenses that will be coming. You got to have things in place for those unexpected moments. You will also learn how to put together proper protection. You got to learn how to protect your family from losing your income. God forbid if something was to happen to you, you got to protect your family assets. So that's why you're going to learn how to plan for if you die too soon and if you live too long. You're also going to learn how to build wealth. You will also learn how to build wealth because you got to learn how to outpace inflation. Let me give you a tip. Write this down. The way that you outpace inflation is by learning how to get compound interest. That's how you learn how to keep up with the pace of inflation. You got to learn how to get compound interest and learn where to put your money so that way your money don't get taxed upon distribution. These are the 2 things that will help you to win the money game. Learn where you can get higher compound interest and where to get tax-free distribution. And most importantly, you also got to learn how to preserve your wealth. You got to learn how to avoid probate and actually reduce your taxation on your estate. So it's important for you to learn how to put together a trust and not just a will. These are things you're going to learn here with us. So that's why we teach people how to conquer their financial future. So you see, Rashida, we empower people with financial education. That's why HGI empowers people with financial education on topics such as the following things. Here's some of the things you're going to learn here in our program. You're going to learn about things like the Rule of 72. A Rule of 72 is pretty much a basic principle on how money doubles over time. You're going to learn how that works. You're going to learn about the power of index contracts. Now, I want you to imagine this, right? Imagine this, Rose. Imagine being able to participate in the success of the market with a 0 loss guaranteed. Imagine you could earn money, but when the market crash or correct itself, you never lose a dime. It locks in all the gains. That'd be awesome, right? So imagine this. You're also going to learn about accelerated living benefits, meaning that your life insurance. You're going to learn about life insurance that you can have, right? That you can use while you're alive and you don't have to die to have access to it. And on top of that, Rashida, you're going to learn about the wealth flow formula. meaning that you're going to learn that your financial needs change over time. That's why I tell you, you got to plan for 2 events in your life. You got to plan for if you die too soon and if you live too long. These are things you're going to learn about in our program here. So let me help you understand what is the rule of 72. If you have no idea what the rule of 72 is, I'm going to help you to learn it today. So the rule of 72 says, if you take 72 and you divide it by the interest rate, that will estimate the number of years it would take for your money to double for you or against you. So imagine that you had your money in the bank, right? And the bank gave you 2%. Now, if the bank gave you 2%, you're going to take 72 divided by 2. That equals 72. So that means, not 72, 36, right? Correction, 36. So your money will double every 36 years. Every 36 years, your money will double. So imagine you're 29 years old and you deposit your money, you deposit $10,000 one time and you want the money back at 65. Due to the fact that when you doubled that money, it only doubled one time in your lifetime, because 36 years from 29 to 65, you realize that they only had a chance to double once. So that $10,000 only grew to $20,000. Now we both know the bank don't give us 2%. But let's say that the bank gave you 1%. 72 divided by 1 equals what? 72. That means it would take you 72 years if the bank gave you 1% on your money. But what if we teach you where you can put your money where you get 4%? 72 divided by 4 equals 18. Your money will double every 18 years. So from 29, you deposited $10,000 one time. And now at 47, it grew to $20,000. And from 47 to 65, it grew to $40,000. May not be a lot, but it's way better than 2%. But what if we teach you where you can get 8%? 72 divided by 8 equals 9. Money double every 9 years. So from 29 to 65, your money would have doubled 4 times and grew to $160,000. See, this is the thing that we got to understand. When you receive higher interest upon money, your money will grow faster. When you receive lower interest against your money will grow slower. In other words, it's actually dying. That's why you got to make sure you learn about compound interest. So we teach families how to get 8% or better in interest upon their money. So what is the power of index contracts? Well, these are something that we got to think about. You see, many people sacrifice the returns for safety, and other people sacrifice safety for returns. So when you think about the indexing, right? Index pretty much brings the best of both worlds together, where you could get the growth and the safety. So let me give you an example. Imagine that you had $100,000 and you invested it in 1997. And you put this money in the top, some of the top market cap companies out there. So we're talking about you started investing like in the S&P 500, stock market, all these different things, right? And by doing so, let's talk about the journey of when it's now 2014, August of 2014. How would that money would have performed all over over the time? So Rashida, imagine you started off with 100,000 in 1970 in August. By August 2014, it would have grew to $219,617. But look at the journey. Being in the stock market, it goes up, it goes down, it goes up, it goes down, it goes up, it goes down, right? I call it bipolar money. It's like a roller coaster. Whoop, up and down money, right? You can't predict it. But let's look at the index. Did you realize that every time when the market goes up, yes, the index performed very well as well. But when the market goes down, what happened? It doesn't participate. It locks in your gains. So every time when the market goes down, it locks in what you already made. When the market goes back up, it goes up with the market. When the market goes down, it locks in your gains. When the market goes up, it makes some money. When the market goes down, it locks in your gains. Look at the outperformance. Now at August 2014, your $100,000 would have grew to $245,037. It performed way better than the stock market did, because you can't predict how well the market will do, but you always got to have protection against when the market drops. That's the reason, that's the power of the index contracts. See, your loss hurts you more than your gains could ever help you if you don't understand that. When does 50% cost you 100%? Let me break it down. Rose, let me give you this example. Imagine year one, you invested $10,000, right? And the market dropped 50%. You lost $5,000. So you end year one with $5,000 in your account. Here comes year two. Year two come around, the market bounced back. It did 50% perform at 50%. Now you made, not the 5,000 that you lost, you only made 50% on the 5,000 that you started with. So you make about $2,500 at this moment. So now you finished off year two with $7,500. So in this actualization, you actually lost 25%. You actually lost 25%. But now, year two, let's look at a different example. This is why we tell you that you would need, Rashida, you would need 100. You would need 100% gain to recover from a 50% loss. And that's why I show you in year one, if you started off with the same example, you invested $10,000, you lost 50%. Now you lost $5,000. You finish year one with $5,000 in ending value. Year two come around, you start with $5,000 again. You would have to hope and pray that the stock market did a return of 100%. But let me ask you this. When have you ever seen the stock market give a return of 100%? Because that's the only way you're going to make back your $5,000 and end that year with the $10,000 that you have. So in actualization, you actually didn't get no gains. You gained zero gains. So that's the reason why with the index contracts, you never have to worry or think about recovery from a loss, ever. That's the power of the index contracts. Now, let's talk about the accelerated living benefits. These are some things that you're going to also learn about here too, Magdalene. You're going to learn that you got to understand that you got to protect. You must learn how to protect your lifetime savings by using the leverage of life insurance with accelerated living benefits. What do I mean by this? Now, accelerated living benefits are essential for the following things. You see, let's think about this and let's be realistic. Is it fair to say that we're most likely to get sick before we die, right? I would not hope we will become, but the odds that we may, right? Now, what are some of the sicknesses we're talking about? We all have witnessed people that have, that have pretty much, undergo a heart attack, stroke, cancer, right? These are things that are normal in today's day. But then, did you know that health insurance will not cover all of these costs either? Now, let's think about some of the costs that health insurance will not cover. Your health insurance will not pay for your mortgage, your loss of wages, utilities, food, college for your kids, right? Medications, certain medications and procedures, they won't pay for that. If you have any, terminal or chronic or critical illnesses. Did you know that at 65 years old, when you go on Medicare, Medicare pays $0 for long-term care services after the first 100 days that you were using it and needing it? Did you know that life insurance, that's why it's important for you to learn about life insurance, that you don't have to die to use. And that's why we teach families and we show them how to qualify. Imagine being able to have access to your life insurance death benefit instead of using your money. Instead of using your money in life savings to cover for any chronic, critical, or terminal illnesses. You can use your death benefit while you're alive to take care of any adult health care that is needed, homemaker services, home health aides, a nursing home, nursing private homes, or assisted living facilities. You can use your money while you're alive. You don't have to die to use your life insurance. That's why it's important to learn about the living benefits that it's also associated with your life insurance. These are things that we teach you, how to set that up. But most importantly, when it comes down to the wealth flow formula, you need to change your needs going to change over time. But you always need to accelerated living benefits. Let me talk to you why. Remember when I said that you need to plan for 2 events in your life? You got a plan for if you die too soon and if you live too long. Now, in the early years when we're younger and we have a lot of responsibility, this is called the wealth curve, the X curve, right? And the X curve said that when we're older, when we're younger, right, when we're just beginning, we have a lot of responsibilities and we have little wealth. Why? It's because in the early years, since you haven't had time to accumulate wealth, you must pretty much rent a substitution form of wealth, and it's called term insurance. So when you own term, it's because you have a lot of responsibilities. So today you got to learn how to protect your income. You got to make sure that your children will never want for nothing if God forbid something was to happen to us. You got to make sure that your debt, your high debts can be paid off. The mortgage can be paid off. That's why I said it's important for you to know your dime. So when you do this, if God forbid a loss of income would not be devastating to your family, because why? You make sure you put the proper amount of protection in place for yourself and your family. But now, as you get older, the X curve, your responsibilities would have decreased as you get older, and your wealth would have increased over time, because I always tell people, own term and invest the difference into cash value life insurance that gives you the ability to grow and get compounded interest and tax-free money when you need it. So that's why in the later years, you would need to protect against living too long and income taxes. That's why we tell people how to buy term and invest the difference into index universal life insurance. So that way you can build up wealth. So tomorrow, you got to worry about protection. While today, you got to actually think about protecting your income. So number one, your kids will be grown. Your debts would have been lowered. Your mortgage would probably been paid off. And at this moment, tax-free lifetime income is needed. And there are so many great instruments that we have to educate families to teach them about so they will have access to this. So when you think about what we have here and what you have in access to, Rashida and Rose and Madeline, that you guys have access to a wealth of resources. You have access to a wealth of resources. And the fact that we offer a wide variety of products and services within the financial industry. And we work with major companies. I'm talking about companies like AIG, Allianz, Athene, Nationwide, Prudential, North American. These are some of the top companies out there in the industry. And we work with them. That's why we're able to provide not only services and give you options and choices, but most importantly, you get education. Financial education, so you can make a financial decision. You make an educational decision. No emotionals. We don't want you to make an emotional decision. We want you to make an educational decision. And these are things that we teach you how to do. So one of the things you got to learn is you got to understand the banking system, right? You got to understand the banking system in order for you to know where you should be putting your money. Let me break it down for you. This is your deposit, right? When you take your money, your hard-earned money, and then you put it with the bank, putting your money with the bank, this is called fractional reserve banking. Now, you may wonder, say, well, what is fractional reserve banking? Fractional reserve banking is a banking system that requires the banks to hold a portion of our money deposited with them as a reserve. The bank use customers' deposits to make new loans and award interest on the deposit made by their customers. So for other words, the meaning that the bank is only required to hold 10% of our money in the bank, and they could then do as they please with 90% of it. That's fractional reserve banking. But imagine they take our very own money and loan it out to someone else at 13, 14%, but they're giving us less than 1% of on our money there. Now, you know what the bank do with our deposits? The bank then take our deposit and then they do something what's called bank-owned life insurance, also known as BOLI. And this is a product where the bank is the policy beneficiary and usually the owner. So such insurance is used as a tax shelter. Do you hear what I'm saying to you? The banks use this because they could get tax-free money when it earns. So they use it as a tax shelter for the financial institutes which leverage its tax savings provisions as a funding mechanism for their employee benefits and many other endeavor. Now, this practice that the bank do with the insurance company is called infinite banking. And that's how many people have learned how to create their own bank. Now, here's what the bank, now, let me give you the relationship that the insurance company now have with the bank with your deposits. So what the insurance company does now with your deposit is that the standard deposit insurance amount for your money that's deposited in the bank is $250,000 per depositor and per insurer bank. So for each account ownership category, pretty much the FDIC would insure the deposits that a person hold in an insured bank separately from any other deposits that the person may own in other separate categories or chapter insured banks. So if you put your money in the bank and you had $250,000 in the bank, it's insured. But the question you got to ask yourself is this: what happens if you deposit $1 million in the bank? How much of it is insured? Only $250,000. But this is why we show families how to cut out the middleman, the bank. It's important for us to learn how to cut out the middleman, the bank, and take our deposits and go work directly with the insurance companies. That's why we teach you how to get better interest than the bank by working directly with the insurance companies and position yourself where you can get growth. You can get a growth of up to uncapped compounded interest. Your money will have the safety where they guarantee you no loss. And it will give you protection where you get living benefits. And you also get tax advantages, which mean that you get tax-free distribution and tax deferred on your growth, meaning that you don't pay no tax on the gains. That's how this bad boy works. That's why we teach families how to be their own bank, how to create their own private bank. So at the end of the day, what is required for you to learn this? You got to put your money where you get these 4 things. If your money's not getting these 4 things, your money's not getting nothing. You got to put your money where you can get growth, safety, protection, and a whole lot of tax advantages. What do I mean? Once again, you want to put your money where you can learn how to create your own bank, and now you put your money where you get growth, uncapped. We have instruments and access to companies that is offering uncapped strategies to families. We can get uncapped compounded interest. And most importantly, you have the safety of a 0% floor, guaranteed no loss. And the protection where you can get living benefits, where money for care for if you get chronic, critical, or terminal illnesses. And you also get a lot of tax advantages. Where you get tax-free money, where you get tax-free withdrawals, tax-free loans, tax-free death benefits, and tax-deferred income, which means that you pay no tax on the gains. So that's why when you sit down with people like us, we show you, and we're going to teach you, Rose, how to strategize and create what is known as an index universal life insurance. Let me give you an example here, Madeline. John is 40 years old, right? And he's a non-smoker. He makes $50,000 a year. He started to save about $500 a month for 20 years. And he would have put in a total of $120,000 and get the following things below. As far as an example, what we're going to use the example on is that let's say that John only earns 6.59% compounded interest on this. And he still has the floor of 0%, meaning that he'll guarantee to never lose when the market goes down. So let's talk about the protection that he would have. At this moment, John would have made sure he had a protection where if for living benefits, money for care, if he was to have any chronic, critical, or terminal illnesses, he would have available 100% of the death benefit, which was $500,000. And then the tax advantages that he would have received is that he would have had a tax deferred growth of the $150,000. And then he would have tax-free withdrawal at the age of 65 because he started saving at 40. At 65, he would have grew where he have tax-free withdrawal of $214,000. he would have available $214,871 that he could take out as a tax-free withdrawal or a tax-free loan. If he took the money out at age 100, it would have grew to $2,836.66. And if he was to pass away at 65, his family would have received $500,000. And if he was to pass away at age 100, his family would have received $2.8 million plus dollars. That's the power of creating an index universal life insurance when it's properly strategized and put together for your purposes. So pretty much, what's the next step, right? What's the next step for you guys? Well, let's begin your financial independence plan. You see, our commitment to you is simply this, Rose. We're going to help to provide you with a free financial needs analysis, and it's going to be based on the information that you provide to me. So Rashida, we're going to help you to identify and strategize that could help you. So we're going to address some of your concerns. You know, Madeline, we're going to always address your concerns. Like we always ask you, what is that concern you about your finances? We want to know that. We're also going to help you to fill in the potential gaps. You know, Rose, we're going to start your path to financial independence. But most importantly, all I ask that you commit to me is simply this. If I do a very good job and I put together a strategy, meaning that we're going to put together your fin, we're going to talk about a budgeting plan, we want to show you how to create a financial foundation, and we're also going to show you how to use wealth formulas to build up your savings and investment. If I do a good job of doing that for you and your family, all I ask is for you to refer me to at least 10 to 20 people that I could educate on your behalf. I work on referrals. And that's how we're going to get to our goal of helping 1 million families within the next 3 years. We want to educate as many people as possible. And that's the only thing that we ask of you. So let us earn your referrals. Let us earn your business by empowering you first with financial education. And also help you with a roadmap so you can start winning the money game. So all I ask you to do is say yes. Yes to your dreams. And our dream starts with financial education. So I just want to thank you all each for giving me the opportunity to share with you what is that we do, how we do it, and why we're helping families. So at this moment, I will just open it up for anybody to have any questions, and I'm here to answer them and talk about, you know, what is your next step? And also, what we're going to do is I'm going to share with you a link where you can fill out a short survey, right? You just fill out a short survey, share your feedback with us, and let us know how we can help you and your family to start winning the money game. All right. So at this moment, I'll open up the call for anyone that have any questions, and I'll be more than happy to help you to get some more understanding. Any questions, guys? And thank you, everybody that tuned in online as well.
It's 11:01.